Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's episode, we're actually going to be talking about a pretty important topic which a lot of traders, especially beginners and inexperienced traders who are still struggling to become profitable, tend to struggle with. And that topic is finding the best currency pairs to trade in the Forex market. Okay, because the reason why I chose this topic specifically to talk about in this week's episode of the class is because a lot of traders find it difficult to profitably trade the markets, not because they don't even have a good strategy to begin with, but it's because they are even trading with an instrument they are not even in line with, in tune with, if I might put it that way. Okay, because here's one thing a lot of traders don't know. Okay, different trading strategies react differently with different currency pairs. You might have a trading strategy that works perfectly with gold, for example, but then when you try to use that same trading strategy on currency pairs like the Euro USD or less volatile currency pairs like the Euro GBP, for example, they would struggle to make a profit, because they have completely different behavior patterns and characteristics. Okay, so most times you'd see that traders are trading with a trading strategy that fits their personality, but that particular trading strategy does not fit the profile of the currency pair they are trading with. So let me give you an example. Let's assume that you're a trader who likes to trade trending trending trading strategies. Okay, trend following trading strategies. By virtue of them being trend following trading strategies, you need to the trading strategy, the way it's going to work is you're going to have multiple small losses, and then you're going to have a handful of big wins, which are going to not only pay back for those losses that you incurred, but give you extra profits in the process. And so when you're trading with strategies like this, you want to find instruments that trend very well, very volatile trading instruments. These trading strategies could work very well with instruments like gold, which tends to move a lot. It's probably going to work well with currency pairs like the GBP JPY, which also moves a lot. But let's assume that you're trading this particular trading strategy with less volatile trading instruments, one that does not move as much as the ones which I just mentioned here, which is gold and the GBP JPY, for example. Then you'd find it very difficult for your trades to really hit those home run wins that you need in order to pay for those losses that you incur, because by virtue of them being a trend following trading strategy, usually your win rate is going to be very low. It's not uncommon to see a profitable trend trader with a win rate like 30 to 40 or 50%. My trend trading strategy, I've told you guys not once, not twice, multiple times in these classes, it's less than 50%. It's just around 40 something percent. But then I still end up being profitable. And the reason for that is because my wins usually are 2, 3, maybe even 4, 5 times more than my average losses. And so just a handful of wins would cover for, a losing streak or an entire drawdown and pull me out of it. Okay, so going back to the topic of discussion of today, a lot of traders, especially ones who don't really understand how trading works, struggle to become profitable, not because they're trading with trading strategies that don't work, but because they're trading instruments that do not align with their trading strategy. Okay, so before anything else, make sure the trading strategy that you're trading with or the pair that you're trading is in line with the way you approach the markets. If you're more inclined towards trading with trading strategies that are trend following trading strategies, then make sure you are only trading that trading strategy with instruments that are volatile enough to give you those moves that you need to give you those big winning trades. Okay? But if you're somebody who doesn't really like trading instruments that, are very volatile, which requires you to, take a lot of small losses and a couple of handful of wins that will give you big profits, then you might want to trade slower moving instruments that are a little less volatile. And for traders like this, trading with trading strategies like that are structured around support and resistance, or trading strategies that are less inclined towards trend trading and more towards strategies that are range bound trading strategies or consolidation market trading strategies, then if you know you're that type of trader, you need to pair that kind of trading strategy with an instrument that is not going to go haywire all over the place when you're trading it. Okay, so this is very important. Okay, now that said, another very crucial thing I want to draw your attention to is the fact that a lot of traders think that they just need to trade to be able to trade all the instruments that are available in the market. So let me give you an example. This is my market watch window. Okay, so when I open up the market watch window, you'd see that I have a lot of currency pairs here, but without a shadow of doubt, you notice that the only currency pairs that I've marked in red here are the GBP JPY currency pair and the USD JPY. I would like to think of myself kind of like a specialist for this particular currency pairs because of the trading strategy I use to trade with them. Because not only I'm not trading them blindly. I'm actually trading them with calculated risk, because the trading strategy I'm using to trade them, I've back tested it, forward tested it, and tested it live on the GBP JPY, for example, and I've proven that it's actually a profitable trading strategy for this particular currency pair. So I didn't just wake up one day and said, okay, this is the currency pair I'm going to trade with this trading strategy, and just jumped blindly into the market and started placing trades. I actually tested it to prove to myself that the trading strategy and the currency pair are a good match for each other. And one thing that's going to surprise you is that this particular trading strategy that I've made a ton of money with, using it to trade the GBP JPY currency pair, I tested it on the Euro USD currency pair, I tested it on the GBP USD currency pair, and they all struggled to make me profits. Not because the trading strategy was different or anything. It was the exact same trading strategy that I used to trade on the GBP JPY. But because these currency pairs, like I told you earlier on, they behave differently. They have a kind of like a pulse to them, a rhythm to them. Each of them, it behaves differently. Okay, so because of that, the trading strategy that was profitable for me with the GBP JPY currency pair, when I tested this exact same trading strategy with the Euro USD and the GBP USD currency pair, it struggled to make a profit. In fact, it struggled to break even. Okay, if I even remember clearly, it was kind of like on the losing side for most of them. Now, the reason why I bring this up is because a lot of traders think that, when they just watch a trading strategy video on YouTube or somewhere, they learn that the trading strategy from the guru, he says that it works, and he shows them that it actually made him a couple of $1,000 or whatever. They'll just ignore testing completely, and then they'll just go and start trading the trading strategy with every currency pair out there. They would launch all the currency pairs or tradable instruments here, and then they'll just rush out to the markets and trade, thinking that because the trading strategy works for the guru, it's going to work on every currency pair. And that's not the case. Before you trade with any trading strategy, you've got to do your due diligence. And your due diligence in this case is you first want to test it out with one currency pair at a time. So, in fact, I don't even want you to do automated backtesting. Do manual backtesting, because that's going to give you a feel for how the trading strategy reacts with price action, and then you're going to see firsthand how it behaves, how it works with it. So if it's profitable with this currency pair, you'd see it. Then you test another currency pair. Before, in a nutshell, what I'm just wanting you to know is that before you deploy a trading strategy to the markets with any currency pair, make sure you've tested it beforehand and you've seen with proven data, statistical data that has statistical significance, quantifiable data, that particular trading strategy is in tune or is in line with that particular trading instrument that you're trading. And that's when you can deploy it to the live market with real money. If you don't do it like that, then you might be trading with a trading strategy that it's not as if the trading strategy is not profitable, but it just could happen that trading strategy is not profitable or in alignment with that particular trading instrument. Okay, now with that said, we need to move on to the next piece of advice which I've got for you about finding the best pair to trade. And that is, trade, first and foremost, try to trade with the major currency pairs. So for those of you who are completely new, for our blank slates out there, what are the major currency pairs. In a nutshell, major currency pairs are the currency pairs which include the United States dollar as either the base currency, which is the first currency in a currency pair. In this case, the first currency on the currency pair, Euro USD here, is Euro. So Euro is the base currency. Or the quote currency. In the Euro USD currency pair, USD is the quote currency because it's the second currency in the currency pair. Okay? So the major currency pairs that we have in the Forex markets, a handful of them, is the Euro USD, the GBP USD, USD JPY, USD CHF. Some traders like to include the USD card to that list. Okay, so the reason why I say if you're just starting out, you should try to find trading strategies and test them with the major currency pairs is because not only are they the most traded currency pairs on the entire planet, but they also, because they are heavily traded, they also tend to offer you the best cost that brokers are going to charge you. So what do I mean by cost? You see, when you are placing trades with a broker, okay, the broker, the Forex broker you're trading with is actually serving kind of like an intermediary, like a middleman between you and the spot Forex market. So when you're trying to place a trade in the Forex market, the broker is going to take your order and link you to the market. Now, because he's offering you this as a service, he also needs to get paid. If not, he's not going to have the money to pay for his infrastructures, to pay for his staff, and keep the ball rolling, to keep the engines going, so that he can facilitate this service for you. And so, the way brokers get paid is one of two ways. The first one is they charge you what is known as a commission, and the second is they charge you what is known as spread. Spread is usually the difference between the bid price and the ask price of a currency pair. And that's why when you place a trade on a currency pair, immediately you place that trade, you see that you're in a negative. And that's because of the spread, the difference in the bid and ask price. And so when that trade that you placed, the reason why it's immediately in the negative is because of that spread, which is what you're going to be paying the broker for the trading position that you placed. If it moves in profit, you have to first overcome the negative effects of that spread and pay the broker before you get to your profit. Or if it's going to move in a loss, since you're already in a loss, it's just going to increase that. Eventually, whatever does happen, the broker is getting paid either way. Whether you win a trading position or you lose a trading position, brokers get paid. So, what does that have to do with anything? Well, when you're trading the most traded currency pairs in the world, the most liquid currency pairs like the Euro USD, GBP USD, and the rest of them, you're going to get the best spreads because since they're traded heavily, brokers tend to charge you a lot less for them. But when you're trading something like the exotic pairs, which are, not traded all that much like the majors, something like, to give you an example, let's say you're trading the United States dollar against the South African rand, for example. Even though, yes, it's a Forex currency pair, you tend to notice that because it's not a heavily traded currency pair, it's going to have a very, very high cost of trading. Okay, so the spread is going to be very, very wide, and the commissions might be very much more than the average commissions of the major currency pairs. And so trading as it is, in and of itself, is hard enough. And so you don't want to add the extra burden of you having to trade an instrument that is very expensive to trade, to add to that burden for you. So what I mean is, you need to find a trading strategy that works. And then not only do you need that trading strategy to work perfectly and give you profits. When I say perfectly, I don't mean it gives you 100% winning trades. By this level of the... Okay, let me put it this way. By this stage of the ITU Forex classes, I'm pretty sure you guys understand that trading, there's no way you can trade without taking losses. And the only way we walk around taking losses is we do it with proper risk management at the right strategy and right mindset, the psychology. So that when you lose, even if you lose more trades than you win on average, your losses are going to be very small compared to your wins. And that's the reason why your wins are going to cover for your losses and give you extra profits in the process. So no matter how good your trading strategy is, you're not going to take winning trades 100% of the time. That's clear. So when I say your perfect trading strategy, I mean a perfect trading strategy for your particular situation, for your particular trading style and temperament, and how you like to approach the markets. So when you are trying to become a consistently profitable trader, remember what I told you. You need to find an edge. So an edge is simply you find a trading methodology, something that will tell you when to buy and when to sell, how much to buy, how much to sell, when to take a loss, when to take a profit. All of this thing is called the trading system. That's your edge. Okay. So you need something that's going to give you that advantage over the market. And so that advantage in and of itself, for you to be able to make more profits than you lose, you don't want to add another difficulty level to it by trading currency pairs that are going to give you extremely expensive trading costs. And that's the reason why I said, if you're trying to get started, especially if you're struggling to become profitable, try to stick with the major currency pairs. The reason is because you're going to get a very, very good competitive cost of trading for these pairs, and so your edge is going to perform at its best, assuming you have a good edge to begin with. So these instruments usually tend to offer you the lowest trading costs. Okay. In fact, some brokers, because they want to attract as much clients to them, they would even tell you that they offer you zero. And that's why these instruments are usually going to charge you the least cost of trading. Okay. So they're also easier for traders who are just getting started to trade with, because they're very volatile and very liquid to trade with. They usually tend to react to technical analysis that you're going to learn a lot better than the illiquid currency pairs that are out there. So let me give you an example. If you take a close look at the charts here, you'd notice that this is the chart of the USD JPY currency pair. A couple of weeks back, we talked about break and retest as a trading strategy. And I told you how the markets move in cycles. Okay. So when the market is trending to the upside, usually what you're going to find is that price is going to be forming higher highs and higher lows, higher highs, higher lows, higher highs and higher lows. As long as the trend is intact, then price should continue doing this. But then there's going to come a point in time where, because nothing lasts forever, there's going to come a point in time where price is going to struggle to continue moving up, and then it's going to either start finding resistance, and then maybe, temporarily stalling or consolidating or even reversing altogether. Okay? Now, what does this have to do with anything? Well, this is technical analysis 101. When you have support, it turns to resistance, and that's why break and retest trading strategies tend to work very well. But then you could see that without cherry picking, this is a very good example of that in action. This is the USD JPY currency pair, like I told you, and you'd notice that a couple while back, price was actually forming lower lows and lower highs. Okay, lower lows, lower highs, lower lows. But then here it was struggling to break below this low, and so we had this switch that I told you. So price went from forming lower lows and lower highs to now it broke the lower high, and from then onwards, it now started forming the market structure of an uptrending market, which is the formation of higher highs and higher lows. Higher highs, higher lows. Higher highs, higher lows. So this is exactly what a break and retest trader would like to see. And so after he would have established the direction of the market, okay, you could see that price broke above this lower high. Now price is, whenever resistance is broken, it turns into support. And when support is broken, it turns into resistance. You can see that this lower high, which was resistance previously, when it got broken above, when price retested it, this level acted as support. Now you can see that it acted as support and liquidity was taken out before it started moving up. Now this clean market structure or price action that you're seeing here, part of the reason why it works so very well on currency pairs like the Euro USD, the USD JPY and all of that is because they are heavily traded instruments. And because of that, most of the times technical analysis tends to, it becomes kind of like a self-fulfilling prophecy, because technical analysis, because of the sheer volume of people who are seeing them on their charts and acting upon them, it tends to work very, very well for these instruments. But when you're trading illiquid trading instruments, like the example I gave you earlier on, the United States dollar against the South African rand, or for example, the United States dollar against the Singaporean dollar, for example, you'd notice that they're not going to respond as precisely to price action or technical analysis concepts as these tradable instruments that are the most traded in the markets are going to do. Okay, so again, let me show you a quick little example. Here you can see, using that same break and retest trading strategy analogy, you can see that when this resistance was broken, it turned into support and it acted up here. This was also another resistance. When it was here, it was tested, and eventually when it got broken, it was tested here and it turned into resistance. So a break and retest trading strategy trader would have easily spotted this, saw the break, and then traded something like this, going for 1:2 or 1:3 risk to reward ratio, whatever the case might be. The trade in and of itself is not what I'm drawing your attention to. It's the fact that technical analysis concepts like support breaking into support turning into resistance, or resistance turning into support when it's being violated, and all of that, these technical analysis concepts that we've talked about time and time again, they tend to work or react perfectly with instruments that are heavily traded, like this particular major currency pairs. Another example here, resistance, and then eventually price broke above this resistance level, and you can see when resistance gets broken, it turns into support, and you can see that after it acted as support here, price continued moving up. The same thing here, resistance, price broke it, turned into support, continued moving. If you're trading with this heavily traded instruments, you're going to see this time and time and time again. Okay, time and time and time again. That's one of the reasons why they're easiest to trade, because they are traded heavily. They are much more easier for you to trade. The cost of trading them are much less. Okay, so it's got all of the benefits for you to trade them. Okay, so moving on. The next thing you need to understand is a pair's personality. Okay, so for example, excuse me, like I told you earlier on, every currency pair tends to have a peculiar way it behaves, a unique way it behaves and reacts to price action. So just giving you a quick example of a couple of currency pairs, okay? You'd see that the Euro USD has cleaner trends, okay? The reason is because the Euro USD is the #1 most traded currency instrument on the planet, okay? And because of this, it tends to kind of like become a self-fulfilling prophecy. So when most traders are trading it the way that, they're seeing these common chart patterns or concepts that are traded, like support and resistance and all of that, key levels, round figures, everything, when more and more traders are looking at those levels and acting upon them and trading them, that tends to reinforce the concept that this particular method works with this currency pair. And so what does that result in? It results in cleaner trends that are less erratic. Less erratic in the sense that they don't just make violent swings, okay, that don't make sense at all, okay? And that's because of how liquid they are. Every pair, like I keep telling you guys, every pair has a rhythm to it, okay? The GBP JPY is volatile, and the way it moves is completely different from the way something else like the Euro USD, Euro GBP currency pair moves. Okay, and so one of the things you really want to do is you want to find a trading strategy that fits your personality. Like I keep telling you, if you're somebody who doesn't mind taking, a lot of small losses and then, finding all of those big winning trades, then trend trading might be for you. And currency pairs like gold or the GBP USD or the Euro USD, they tend to trend a lot. So you might want to trade those kind of currency pairs, because if you're a trend trader and you trade with a trading instrument that is not very volatile or it doesn't move that much, then you're just going to struggle, because it's not going to be moving as much as you want it to give you those profits that you need. In fact, before you even come to this level of trading the currency pair in the live markets, you must have done your prep work, which is to define your trading strategy and then backtest that trading strategy with the currency pair to see if it even works, which is one of the things that a lot of traders don't even do. Inexperienced traders, they don't even do that. They just find somebody talking about a trading strategy on YouTube or mentor or whoever it is, trading it on a random currency pair, and then they just assume that it works and start trading it with every other currency pair out there under the sun. And like I just gave you an example of myself, I trade with a trend trading strategy that works perfectly for the GBP JPY currency pair, but it struggles to make a profit with currency pairs like the Euro USD and the GBP USD. And this is partly because the rhythm of the GBP JPY is completely different to the rhythm of the Euro USD and the GBP USD. And so the way it works with those currency with the GBP JPY is not the way it's going to work with those currency pairs. They might need some tweaking or some optimization for it to work with them. Okay? And so GBP pairs, you notice that they have larger moves and they are more volatile. Okay? JPY pairs are strong directional behavioral pairs that when there's a risk on or risk of situation in the markets, it usually tends to affect them a lot. Gold, well, I could say that gold is not too beginner friendly because, with the position sizing and all of that, most of the beginners struggle to trade gold. But then, like I tell you all the time, if you have a trading strategy and you've tested that trading strategy, and it proves that it works with the particular instrument that you want to trade, then there's no reason not to trade it. The problem is when you have a trading strategy, but then you haven't tested it to see that it's going to work with the instrument that you want to trade, but then you still deploy that trading strategy onto that instrument, then that's the wrong way to go about it. Okay, so this pretty much brings us to the end of this week's edition of the class, and I know this must have been a mouthful, but the reason is because this concept is very, very important to grasp. If you don't understand it, then your problem might be not your trading strategy at all, but then the instrument that you're trading. And so this could hinder you. And that's the reason why you need to find a trading strategy that you resonate with and then pair that trading strategy with an instrument that is going to work with that trading strategy or favor it and test it before deploying it to the live market. Okay, so before we round up the class, I would like to use this opportunity to let you guys know about our suite of bots, which are expert advisors or trading robots as they are commonly known as, which are designed to help you look for low risk, high probability trading opportunities, place those trades on your behalf with proper risk management following our recommendations if you follow them step by step, and then to help you start earning while you're learning how to trade and diversify a portion of your portfolio to automated trading. Okay, so if you're interested in that, please reach out to us on the socials, on any of our social handles, or drop a comment in the comment section, drop a question in the comment section, and we'll be more than happy to reach out to you and help you set everything up step by step in a simple and easy to set up manner. Okay, so once again, thank you for taking time out of your busy schedule to come to these classes. I look forward to seeing you guys in next week's edition, and have a wonderful rest of your week and go out there and crush the markets. Thank you, and God bless you all.